We will keep this party going. My name is Lewis Hauer. I'm with Silicon Valley Bank. It's awesome to be with all of you here today. Our panel is talking about the new world of banking, lending, asset management. What does that look like? How is that changing? We've got 4 different perspectives from honestly all over the world that hopefully have some insights into that. But I won't do the formal introductions. I want you to hear from them. So we'll start by just tell us a little bit about yourself, your company, your journey to where you're at today. And if you start to ramble on too long, I'll flag you.
My name is Puneet Agarwal. I run a startup out of India, which is in consumer financial management and consumer lending. Prior to starting MoneyView about 4 years back, I spent pretty much my entire professional career in the US, working with the kind of intersection of financial services and technology. So I spent a fair bit of time with Capital One, which is a financial services company, but uses technology to really kind of innovate in this space. To other end of the spectrum was part of Google, which was getting into financial services through Google Wallet. So moved to India about 4.5, 5 years back because we just see a tremendous opportunity in India. India is one of the most underserved financial services markets in the world, I would say, and there's a lot of opportunity to use kind of the technology to really drive adoption of formal financial products to mass India. So that's what MoneyView is focused on.
Awesome. Thanks, Puneet.
Hi, everyone. My name is Lily. Lily Liu. I most recently had a company called Earn.com, which was a startup in the cryptocurrency space, which was sold to Coinbase about a year ago. Since then, been largely angel investing, advisory in the space, probably predominantly in crypto, also elsewhere. Prior to that, I built a hospital in China. It was totally different. Worked at KKR, worked at McKinsey, so sort of came from more of an institutional background before I defected to cryptocurrency a few years ago, when people still thought it was just drug money.
Hi, my name's Immad. I've been doing startups for 13 years, so this is my 4th company, which according to Justin means I've failed a lot. Mercury is building a bank for startups, a depository side. I also invest in a lot of companies. I invested in more than 100 kind of mostly seed stage companies in the last 3 years.
Good afternoon, everybody. I'm Arad. As you can hear by my accent, I'm an immigrant originally from Israel. And I've been here for the US in the last 10 years. And after working in the financial services based out of Chicago, I basically learned that in the US, there are about 40% of the people do not have really access to credit unless they go to pay the loan. And the other 60%, they do have a credit card, sometimes pay tons of money and interest on your credit card, like 20%, 30%. And when I thought about it, I thought that at the end of the day, people use credit to go and buy stuff in the store. They don't take credit to put in a loan. And realize that while there is a lot of innovation online with companies that provide point-of-sale lending online, there is not really innovation in the brick and mortar when people need to fix the car, need to go to the doctor, go to the dentist, and the only solution that there is basically a credit card. So what we developed at Sunbit is a new product that is built into brick and mortar point of sale when you fix a car, when you go to the doctor, which allows in basically 30 seconds approve 9 out of 10 customers to split the purchase into payment into 3, 6, or 12 months while maintaining a credit card rates, and each customer gets a better rate compared to its alternative. We started 3 years ago, and we are based in Los Angeles.
Awesome. Thank you all. As an attempt to kind of dive in and set a little bit of the stage, I'm not going to do the everyone answers the same questions. We're going to kind of get a few different takes and perspectives. So Lily and Immad, I'm curious to get your takes on the fintech industry overall. Like last year, all-time high of funding raised. We see a record number of companies that are starting to try to come in and be disruptive. You have more and more of the incumbents that are saying, okay, how do we start to dabble in this space? Where do you see the landscape from your different seats, right? Relatively newer, getting something launching off the ground. You've had an exit, but you're also looking at a bunch of early stage companies. What does the landscape look like over the next year to 2 years of this space? Crystal ball this for a little bit.
Well, I think that with as every sort of generation matures and makes money, right? Then consumer tastes always kind of change, and there's kind of a need for new products, right? And financial institutions, at least the large ones, don't always have the reputation of moving super quickly and being at the leading edge of innovation for various reasons. Partially because there are a lot of regulatory constraints, and increasingly so, and also they're just really freaking successful at their current business models. So there isn't a huge amount of pressure to change immediately. But some of the kind of macro trends that I think are really interesting is transactions being inherently more global from day one, right? And potentially requiring a different set of commerce solutions around that. That's sort of more B2B and also sort of B2C, right? You can much more easily scale a business internationally today. If you look at, for example, a lot of micro brands, they start from basically nothing and immediately they have global supply chain, global network of customers. And so the sort of the speed and the scale of that happening and the frequency of which that is happening is so different from even 5 or 10 years ago, right? And then, so that's sort of more an enterprise standpoint. And then also for consumers, I think that, new generations think about, the role of a bank very differently. I think that there's probably a loss of trust from maybe 10 years ago. That's something that we hear a lot, at least in our little corner of cryptocurrency, where people are really thinking, these established institutions, are they really institutions I can trust? And if so, sort of how? And are they really going to meet my needs? Or what sort of networks or what kind of companies are more sort of deserving and more worthy of my trust? Maybe that doesn't actually look like, a JP Morgan or Charles Schwab in the future, right? So I would say it comes down to sort of folks wanting a different experience, having different sort of factors that influence their decision to trust, and also sort of being inherently global from day one.
I think one of the problems with like thinking about fintech is that it's at least, it's like talking about SaaS. Like I think it's like at least 5 or 6 different industries, and they all have these like different kind of forces to them. Like crypto, lending companies, kind of challenger banks, people that sell like infrastructure to banks and other financial institutions, and then payments companies. Like those are like 5 big categories, and they all have like kind of different trends. I think, lending was like super interesting for a while, and then it became less hard, and crypto, So I think it's like, it's worth thinking about those trends as like separate things. There's an overall trend in the industry that like barriers to entry are like lower, but still it's harder to do a fintech startup than it is to do like just a software startup. It's hard to, you generally need more capital. You can't build the whole product in 3 months generally. But there is like a trend of that's going down. But I do think, at least on the early stage, and I talk to a lot of early stage startups just because, we target early stage startups and I invest in that space. I think it's hard in general to like raise money as a fintech startup. The category, at least at the early stage, the 2 categories that find it easier to raise money are like second-time entrepreneurs that have like some sort of, proof point kind of thing, and like people who can like kind of sell into financial institutions. Like then it's more like a SaaS kind of B2B company. So I think it's actually quite hard to start a company. I think the reason like everyone so like feels good about fintech and there's so much investment is actually mostly late stage companies, I think. So, we've got to a stage where like Robinhood, SoFi, Coinbase, Stripe have reached like, they're like, I don't know, 8 to 10 years into their life, and they've reached this maturity where they can raise, 100 million plus rounds. And that actually creates like a counter trend for the early stage companies that like, they're at this stage where they can like compete with almost anything that reaches some sort of like interest level. So I think it's actually kind of still pretty hard to start a fintech company. But I do think if I was a bank, I'd be pretty worried, just because there's so much maturity and talent in the space, and there's so much investing in the space that like I think the monopoly of banks making most of the money in like financial services is gonna like get worse and worse.
Nice, thank you both. Puneet, Arad, I'm going to take a little bit of a left turn on this because there was a point that was highlighted and brought up around the difficulty of fundraising, right? You guys both relatively earlier stage in that process. Not only do you have to raise money for your company, but you're both lending companies. So there's a whole nother layer of type of capital, sources of that capital, which oftentimes in the fintech space leads to either hyper-regionalized or something that is relatively specific to either one industry or one location. So as you think about your growth, both from a fundraising capacity, but also customer segments, how does the regionality factor into where you want to go from a growth perspective and how you have that conversation with your investors?
For me, it's actually been very interesting that I spent a fair bit of my time, my professional career in the US, in financial services, in a very different setting where the industry is kind of at a very high level of maturity, right? Things are pretty set up. Users have access to most products from the 3 or 4 products that you mentioned. They're kind of pretty freely available. When I moved to India, actually, it's a very interesting and a different environment, right? Where there are only about 40 million credit cards in India with a billion plus population, right? So it's when you think about India and the stage of maturity at which it is from a financial services standpoint, it's actually very, very, very early, right? And what that means is the opportunity to innovate is just tremendously high, right, as compared to a more mature market like US. So from that standpoint, you would start, like you would see just in the last 3 years, the amount of money going into fintech in India is actually just growing phenomenally. And that's actually largely driven by just the opportunity out there. So from that standpoint, I think just fundraising by itself from an opportunity perspective is maybe relatively easier as compared to doing that in the US. But I think that the focus is more on, when the investors are looking at it, the focus is more on people who kind of understand this. They have the tenacity to kind of, as it was mentioned, that it's not like a consumer startup where you can build a product in 3 months. Actually, you need to understand this really, really well. There are regulations, and in a country like India, they're changing pretty often, right? So to be able to understand and navigate that is what the investors are looking for.
I think that lending in general, there was a huge bubble in 2014, 2015 that everybody just invested without really understanding. So people invested in companies that really unfortunately didn't bring a lot of value, which is different than the bank value. And that's why right now the business model is kind of not successful, so nobody wants to touch lending. So I think in general, when you raise money, I would less talk about the geography, because still in the US there is a lot of opportunity. As I said, 40% don't have a credit card, and I'm sure that if everybody here look at his credit card in his pocket, the interest rate is actually in the teens or in the 20s, even though I'm sure most of our people are paying, and they can pay when the real cost of money is maybe 1 or 2%. So there is a lot of opportunity, a lot of efficiency to gain, and really you need to find the investors that are think independently, which it's hard to say, it's not always easy. People just do whatever they do, and you need to find the people that, this is actually work, this can work, even though everything that they did before didn't work. You just need to look for it, to find a combination, and I call it, our first one was from Chicago, which is kind of between New York and San Francisco. So I said they hopefully understand a little bit of both. But now we got some money from San Francisco, so we got San Francisco into the mix, and you just keep looking, keep talking. At the end of the day, if you build a good company that adds value, I assume we should be able to raise money. There is no magic to it.
And what is the landscape of debt funding for what it is that both of you are doing? I know India has some different regulatory regimes that you have to pay attention to from a debt perspective. What does the debt side of the equation from your fundraise look like?
I think the interesting part is there's a lot of capital available, right? But the regulations are still kind of very early on, right? Particularly when you get into a new age space like fintech, right, which is kind of changing the boundaries, and the regulations are catching on, so to speak. So I would say from that standpoint, there's plenty of capital available, and there are very interesting business models being created around that. But in a country like India, I expect those to kind of change quite a bit. So for example, right now, it's much harder to get debt capital from outside of India, right? Versus if you were to raise that in India, it's much cheaper, but there's an arbitrage opportunity available because the interest rates or the cost of capital is significantly higher if you try and raise debt in India. And if you have access to capital from Europe or US, it could be much cheaper. So I think over the next 2 to 3 years, I expect a lot of changes to happen, a lot of reforms to come. And from a capital availability perspective, it's not a challenge. It's just a matter of kind of making it more efficient.
For us, actually, I would say the easiest thing to raise,
Yeah.
because our loans are short-term, 3, 6, or 12 months. Average is 10 months. I call it the people from New York, they appreciate it, because all the other loans they need to invest is 5 years, and people are afraid to invest in 5 years. As long as they perform, that is easy. But you just need to make sure the money comes back when you give it.
So I'm going to take a little bit of a turn and ask, you talked about, Immad, you talked about different sectors, all being slightly different, but from your views, and Lily, we'll start with you from the standpoint of, it was just announced a couple days ago, Facebook coming out with Libra, the potential shift that has for everything in the crypto space, whether or not that will come. I'm curious, maybe touch on that a little bit, but then from each one of you, I want to hear, what's the one thing that would be either the expletive moment for your business model, or the this is the pivotal game changer in what it is?
So, there's been a lot of interest and excitement about Libra, or not, depending on who you ask. But I think that there's the concept that it represents, and then there's the specifics of the project. And if you kind of disaggregate those things, for the former, it represents a really momentous shift, right? And what I think it represents is this recognition that the internet is probably pretty significantly under-monetized, right? So Facebook, which is probably the best at monetizing, well, Facebook and Google. Facebook, they have about $20 average revenue per user for all of the time that we all spend in their various properties, right? So that kind of factors out to probably cents on the hour. And meanwhile, so many of these markets, there's either the supply or the demand, either for attention or for actual e-commerce. Both sides of that is showing up on the internet, but it's actually fairly hard to settle that because you've got, 200 different currencies, fairly sort of misaligned payment rails, so on and so forth. And so, in the digital world, it's actually fairly hard to really truly harness all the liquidity of these markets that actually want to clear. And what's really interesting about Libra is it's basically saying, maybe there's an opportunity that we have this community of, basically 2 billion users, right? And maybe instead of sort of mooring that to the nation states and the payment rails that are built around those nation states, we can basically just create our own, right? We're not going to peg this to any one country. We're going to peg this to a basket, right? And yes, many questions remain as to how what's going to be in that basket, how it's going to be set. But it's really sort of the first mainstream expression of this idea that there is kind of this digital economy which will eventually unmoor itself from these sort of nation-based economies that we sort of take for granted as being the market structure today. I don't think that that's going to happen very easily or very quickly because, obviously, countries have an interest in resisting that. And I think you see that in many indirect ways in potentially some narrative around tech and monopoly needing to be broken up, so on and so forth. But I think that's essentially what's the most interesting thing about Libra. Now, whether specifically that project is going to work, I think it comes down to many, many other factors. For example, coordinating the consortium of 30 some odd large companies, never been easy. It's not going to be easy for them. Sort of having conversations with probably 100 different regulators is also going to be fairly challenging, times probably 5 agencies in every country. So basically, 500 different regulatory discussions. It's also not going to be easy. But I think what it represents overall is this idea that digital economies, sort of the beginning and the end point, should sort of be consistent, right?
Nice.
I don't know if there's like a good macro expletive moment for us. I think most of the time,
what are you most excited about then?
Yeah, I think, I guess the couple of upside things for me would be the Republicans kind of have made it easier to start new banks, and there's lots of potential regulatory change for challenger banks, etc. I think that's still early. It won't. Yeah, it would be nice to have, but it's not necessarily a game changer. I think there's a general movement in the U.S. towards being more open to technology-enabled banks. The U.S. is kind of way behind Europe in that, but I think that's happening. So I guess those are like the positive potential trends. Like negative potential trends, I think like most of these things are fairly sensitive to like macro recessions, and potentially like, the space gets like super fragmented and busy, and it gets like too hard to compete and commoditize and all that kind of stuff. But yeah, I think in general, like actually especially with like the earlier stage startup you are, I think it's failure is mostly like, or success is mostly like an internal fight to survive and build something that users want.
Any other takes?
I'll just share some perspective from India, right? Again, there's like no one key moment, but it's interesting. India, on one hand, is one of the most underserved markets. But on the other hand, it's very interesting that it has been able to actually put together some of the most advanced, from a technology standpoint, some of the infrastructure in place, right? So there was a system for bank-to-bank transfer using mobile phones, which is almost 10 years, actually more than 10 years old, where like 24/7 you can actually transfer money from one account to another across any bank account, right? And like very, very powerful thing, right? Which still in the US, it's not that easy. It's probably things have changed a lot in the last 3 years, but until 5 years ago, moving money from one bank account to another account was actually not that seamless. Similarly, there is an equivalent to a social security system in India, which is completely digital, right? It's kind of tied to your biometrics, right? Which is like a platform for identity verification, which is now all these platforms are coming together. I think the key is going to be kind of putting the policy around that to kind of really make it enabled to really drive adoption of financial products and such.
I think in general, for me, it's all in our hands. I mean, the market is big. As long as, again, pretty simple. As long as you get value to the customers, more customer will come. We work with partners, a lot of repair shops. They move around because people move. They move, they get us more. This, as simple as it sounds, if we do well, the economy will be okay for us. There is a lot of things to gain just by adding value for our partners and customers. And with the data that there exists today, a lot of data of, again, we swipe the driver license for the customer, and then we get the entire credit file of the customer just by doing it. And then you know where they buy, what they do. There is a lot of upside to connect actually the financial world into the real world of what people do with this. But this is in the future. It's in our hands to do it.
So one more question, then we're going to turn over to the audience. There were some themes that were picked up of government regulatory coming together. Lily, you talked about the need of, if that is a future digital state, of not only companies, but nations as well as others coming together. Immad, you talked about the changing landscape of potentially new charters or other banking. Kind of what is the role of the either large incumbents and or the governments who are relatively closely intertwined at this point? Like, how does the regulatory framework, you've mentioned of part of it's just time. Are there things that each one of your companies or some of the companies you're involved with that are doing that will change that landscape monumentally? Or is it we just need to wait and everybody will catch up? Keep pecking away, and then it'll change.
So from our perspective, there are actually a lot of advantages of being early in the maturity curve because you actually get an opportunity to influence some of these policy makings, right? And there's a lot of that happening in countries like India, where actually the policymakers are actually seeking you out, right? Kind of really taking your inputs on how the new business models or how new technologies could really enable what they also want to do, which is to kind of have a massive adoption of good products to the consumers. So that's a very interesting kind of difference between kind of countries which are kind of in the developing stage in terms of the maturity of financial products versus countries like US.
I think that with regards to from my vantage point in cryptocurrency, I think that because of the sort of global, natively digital nature of cryptocurrency, it actually enables this industry in its infancy to engage in quite a bit more regulatory arbitrage. Now, sometimes that looks a little bit sketchy. I think that there are forms of it which are actually fairly legitimate and really interesting to look at, as you look at some of the larger companies here that have thought, okay, well, I can set up in places like Malta, in places like Singapore, places like Switzerland, and sort of hopscotch my way to a global business that looks very different. So I think that there's some primitives there which might be interesting to pull from. The other aspect of something like Bitcoin, which I find to be quite interesting, is that simply the very likely price appreciation of Bitcoin in and of itself is going to carry this industry, because what you already see happening is you already see in a place like America, you already see institutional investors, endowments starting to take an interest and starting to invest. And once they have a stake in this and make money off of Bitcoin, then they actually have a very positive view and are willing to sort of be friendly to it. And even a place like China, where sort of the party line is that Bitcoin is no good, if you talk to government officials one-on-one, they actually all love Bitcoin and they all own it a little bit themselves, right? So essentially what's happening is that there's sort of what you say, but then what you do when it comes to cryptocurrency, and that divergence is not permanent. I think it's going to converge at some point.
So I'm from the UK originally, and the UK regulatory kind of body, I think it's called FCA now, they generally are like better than the US ones. Yeah. And that's actually helped kind of technology innovation there. There's like, if you want to do a startup bank, there's a very, very well-defined charter. It's also been like good for consumers, like all ATMs are free. You can do payments like within like 10 minutes or something. And most of that actually comes from regulatory side, which is, the US is like very different, where like regulators seem to be unprescriptive when it comes to like making things good for the consumers, but still quite cumbersome for financial institutions, which is interesting. So, one part of me is like, oh, it'd be great if these things improved. I'm not holding my breath for it. I think mostly the US is, slow in these kinds of things, and that's like partly by design. Which
so why did you start here as opposed to over there?
I mean, there's a lot of innovations
The
already there. It's, the market is like 10x bigger here. I live here, so. Yeah, I mean, the opportunities are just like huge here, and it's actually really competitive in the UK. Yeah. Like there's like 5, challenger banks doing all sorts of things in a market that's 10x smaller. So it's like gonna.
I will just say that I had a chance to work with the UK regulator, with the FCA, with my previous company, and really they did a lot of things to improve the customer life. I mean, the 24/7 funding came from the regulator, which here, if you want to fund, it will be the next business day, which means the customer get approved on Friday, might get it on Tuesday if there is Labor Day, if it's directly to the customer bank account. They basically kill the payday loan market and make it good for customers over there. Here it's more difficult for the regulator to act because there is the state level and the federal level. So I think the way I look at it, instead of waiting for the regulator to do stuff, try to understand the regulator and build your business around it, which actually give you a lot of defensibility. Because if you know to navigate around the regulation and build a good business for the consumer, it's harder for other people to do so. So that's what we try to do.
Thank you all. Questions from the crowd? Anything? We got one. There's one behind you, Dave, and then you.
Arad, Sunbit recently made a very pleasant announcement, having raised some capital. Could you tell us a little bit about the journey? How long did it take, say, for the time you first shook hands to the time you actually were able to make that announcement?
5 minutes. Actually, it was a long journey. And, Trusted Insights are a great investor here, and also Heroic, which were with us in the beginning. So what we are doing is different than everything else is doing, right? Everybody is going online. We actually go to brick and mortar. Everybody is trying to give $10,000 loan to the customer. We're going $500. Which means that 1, it takes more time to do. 2, you need to give more loans in order to grow the revenue. So at first, and still right now, it took people to believe that what we say we're going to do, right? We're going to say we're going to approve all the customer, 9 out of 10 people, and still give them a credit card rate, where the credit cards are given only 50%. So at first, it was really, really hard to find the right people who believe that we can do what we do. Luckily, in this case, we found an investor which knew us from actually for 2017. Again, waited to see that we are growing. And after 12 months of growing double-digit month over month, that was a much easier discussion. We sent him the numbers, we met, and then 3 days later, we got a term sheet. But it's been like 3 years of dating.
Dave, did you have a question?
Apologies if any of you guys are doing this already, but thoughts on new forms of venture debt, or particularly replacing equity financing for customer acquisition with high interest debt. There's a company called Clearmark that I think is doing this. Clearbank, sorry. Seems like at least if your unit economics are positive on customer acquisition, doesn't necessarily make sense to be doing that financing with equity if somebody's offering you debt. And Louis, I guess you guys do venture debt too.
We do.
I guess I could take this. I think it's an interesting model. You know, generally speaking, it comes down to like, what are your cash flows like? So, you know, Clearbank and there's a few other companies in that space are basically like, you know, if you have to spend a bunch of money and that's going to get you revenue in like 6 months' time, then like you have this cash flow disparity, and that's what they're bridging. Whereas if you're like a SaaS company, that often, maybe it still makes sense, but often it doesn't make sense. So, so it's mostly like cash flow bridging. Actually, venture debt or any other form of like bank debt will generally be way cheaper than, you know, there's Clearbank and others do a bunch of like obfuscation to figure out like what's the exact interest rate for that loan, which I'm not a fan of. But either way, I think most bank debt is just going to be cheaper. But the problem is you just don't qualify for it because banks don't understand your data. Yeah, so the hope is, I think, over time, like these kind of data-driven lending options will, you know, fall in price and be closer to just like good debt options. So I think it's an interesting market. I don't think it makes sense for like every company to need it or use it. And it's, yeah, I think it's actually just a different space from like, I'm going to do this instead of raise VC. Like, I think it's that whole thing which like, again, Clearbank actually deliberately puts it as an anti-VC option. I think it's like a different thing. Like VCs, you know, if you really need to go raise like 20 million and grow your business, and it's not like a cash flow kind of tight business, like you should just raise VC. Whereas like if you have a good business and you can raise 20 million in debt and that helps you like bridge some cash flow issues, that's a good thing to do as well. Like those are separate. Yeah, I mean, if you're in a position where like your revenue is delayed in some way, like you deal with hospitals and they pay you like net 180 or whatever, sure, like get debt. But I think it's like, it's not a good option if you don't have that revenue kind of delay situation. I don't think you should be like fueling like, you know, like growing your team by 2x and like all this stuff by getting debt, because the problem with debt is like the downside scenario of debt is like you lose your company, whereas the downside scenario of equity is you might need to do layoffs, but like you can normally survive to fight another day. So like you just have to be careful with it. I don't think it would be responsible to take a bunch of like 10% interest debt just to like, you know, try to find like product market fit. Like that just wouldn't make sense. So.
My one thought to that is the cost of creating a business has come down so rapidly. Just, I mean, late 90s, it was $5 million in multiple months. I mean, there's some sector differences where you're dealing with regulated industries, but now you can start a company for less than 50 grand and start shipping a product. And so to that point, and it's different kind of business models, but to that point, yes, we see more and more companies that are saying, I'm going to bootstrap, I'm going to delay raising equity, I'm going to gain that revenue traction, and there might be an opportunity for either a revenue-based loan or some of the other flexible products to get to the place where you have more leverage over the venture investors because you have revenue and you have traction, and then you're really fueling growth instead of continuing to fuel the experimentation. And I think it's very dependent on the sector and the kind of business that you're building. Yep.
think it makes sense for some scenarios for sure.
It's a treadmill.
But also like, equity, like VC capital is, if you're in that kind of positive position, VC capital is like relatively cheap nowadays. So there's that counterbalance as well.
Well, that seems to recognize that, traditionally venture investors, they would have one flyer for nine companies that didn't do as well, right? And that was kind of like the very binary outcome type of scenario that folks were getting into. To the extent you basically have venture mezz, right? It's typically venture debt and then some warrants and there's cash flows that back up the debt. And if that's the case, then I think that basically is signaling that there's going to be a number of these more mezz outcomes, right? Several $100 million companies that don't necessarily, that maybe even live beyond 5-10 years, right?
Yep. Awesome. Well, we're out of time. Please join me in thanking our great panel, and thank you all.